So good afternoon, everyone. I'd like to welcome everyone here to the annual Economic and Revenue Consensus Forecasting meeting. My name is Blake Washington, Director of the New York State Division of Budget. Is there an echo there? Joining me today on the Joint Economic and Revenue Forecasting panel are my partners in government. We have Senator John Liu, member of the Senate Finance Committee, Senator Tom O'Mara, Ranking Member, Finance Committee, Member Gary Pretlow, Chair of the Assembly Ways and Means Committee, and official congratulations on my behalf for taking the role there. It's awesome to have you there. And Assembly Member Ed Roth, Ranking Member of the Ways and Means Committee. We're also joined by Maria Doulis from the State Controller's Office. And we have today some presenters that are going to share some of their wisdom with us. We have Dr. Lahiri here in person, and virtually we have Hugh Johnson and Tara Sinclair. Dr. Sinclair as well, remotely. Looking forward to hearing your remarks. So today's conference represents an important step as we work towards enacting a balanced and on-time budget, of course. That's our goal. Each member of the panel will have an opportunity to provide some brief remarks. Then we'll hear testimony from a cross-section of the experts I just mentioned who will offer their perspectives on the current economic and revenue status of the state of New York and the nation at large. And with that, I'll just begin with a couple of thoughts, at least how the Division of Budget sees the fundamentals before us. The U.S. economy remained resilient in 2024 as inflation trended downward without a significant increase in labor market weakness. 24 represented a return to fiscal normalcy when we saw tax collections fall to historical trends. And in 25, we saw an increase in tax receipts driven by continued labor market strength and supported by growth in PIT or personal income tax revenues. The resources allowed the state to bolster our reserves. We've avoided debt, and we've continued our commitment to foundation aid, healthcare, mental hygiene, and public safety. Now, since we met last February, the national economy experienced a year of strong economic growth. Many, including the Division of Budget, expected economic activity to moderate further compared to 23 in the face of higher interest rates. But however, solid income growth drove continued consumer spending, and the economy continued to expand at rates seen in the previous year. The division's current forecast estimates a deceleration of growth in fiscal year 26. However, modestly, the U.S. and state labor markets cooled gradually throughout 2024, and despite the slowing, the state finally surpassed pre-COVID levels of employment in April 24, which is good news. The slowing economic growth forecast for the upcoming year suggests that employment, wage, and income growth will continue to moderate through 26, and the state's unemployment rate has remained relatively steady throughout the year, about 4.3%. It's not expected to increase in the upcoming fiscal year as the expansion of the labor force is expected to slow. In line with the CBO, Congressional Budget Office's economic outlook from earlier this year, DOB's economic and, importantly to this process, revenue outlook is premised on the economy experiencing slowing economic growth over the next year while at the same time avoiding a recession. We're aware of many risks to our economic forecast and our revenue forecast, including new tax, international trade, and immigration policies at the federal level, and geopolitical concerns loom large. The parameters and the outcomes of these new policies in Washington remain highly uncertain. And obviously, just before coming in the room, we learned that the tariffs on Mexico, China, and Canada are back on next week. So hopefully there could be a détente there in the interim. But we must be mindful of national budgetary trends. There's volatility in Washington, as I mentioned, which the Division of Budget watches very, very closely, as do my colleagues in state government. And all of those have potential impacts for the state of New York. So, for example, just this week, the House passed a budget blueprint that would cut federal spending by about $2 trillion through the next decade. And details have yet to emerge on exactly how those savings would be realized. But we expect cuts to Medicaid and other federal programs that would otherwise threaten the state's ability to fund current law services. So, along with the partners in this room, with our elected members, with my colleagues in the Senate, we'll continue to engage our congressional members to ensure that we protect those federal funding streams that are vital to sustaining the programs and services that New Yorkers throughout the state rely upon. Throughout the past several years, certainly in this role as budget director, we've worked together with my legislative colleagues specifically to enact budgets that embrace the principle that state spending, absent extreme emergencies, must be in line with our revenues. And all parties deserve credit for enacting budgets that have accepted that framework without taking on new expenses beyond our ability. So each of the forecasts before us today represent a good faith contribution to the consensus revenue and economic process. And I'm interested in hearing from our assessment from the experts, which will, I see some are going to join us in a moment here, but I think in general, my hope is that the panel before us will be able to comment on the risks that come, first and foremost from our elected members here on the panel, and maybe even contribute to some concerns that we haven't yet thought of. I know that we're all committed to meeting the state's statutory 1st of March deadline for a consensus revenue agreement. And this is an important component of us kicking off and getting underway to deliberate a timely and responsible budget. So with that, I'll stop talking and I'll kick it over to Senator Lieu for some opening remarks.
Thank you, Mr. Budget Director. I'm John Lieu. I work for Senator Liz Krueger. She is currently chairing a budget hearing right now, which is why she's not here. But certainly the state Senate, under the leadership of Andrew Stewart Cousins, is fully committed to having accurate revenue estimates and getting an on-time budget in about a month or so. Blake, thank you for your opening remarks. You took everything that I was going to talk about, except maybe the highlight of risks down the road. I've never met a budget director that didn't talk about that didn't highlight the risks down the road. So true to form, good job. But I will say that, New York's economy and tax base remain strong and resilient. And we certainly have seen that in this year's results, the revenue forecast that we're about to look at. But as Blake already mentioned, we have some significant risks, not necessarily due to our own policies here in the state of New York, but certainly federal policies, fiscal policies that potentially will cut funding to many of the critical areas of the state budget and what our state's residents need, as well as inflationary, monetary, and also immigration policy that will serve to potentially undermine our future growth or the growth we otherwise would have had. So I look forward to hearing from the experts here and to come to consensus on the revenue for the state of New York, certainly by tomorrow's deadline. Thank you.
Thank you. And now we'll turn over to Assemblyman Pretlow.
Thank you, Mr. Budget Director. Thank you very much. I appreciate the opportunity to be here today with my partners in government and look forward to hearing the panelists' thoughts on the economic outlook for both the state and the nation. I'm looking forward to hearing each of the presenters' views about the outlook for New York State's economy and various risks and uncertainties that we face going forward. Their experience is invaluable. Although the state's economy remains resilient despite various factors that jeopardize growth, the state continues to lag the nation in several key indicators and faces a slowing growth of employment and consumer spending. Inflation remains a concern, and we are acutely aware of the impacts that it has on many households in the state. I'm interested in hearing the panelists' outlook on the national and state economies, both for the short term and the long term. Furthermore, any insights that they can provide on the state's tight labor market as the impact of tariffs and potential decrease in federal spending would be particularly helpful. This analysis is important to us as we look toward evaluating the current economic conditions and the best collective response we can put forward. Your independent viewpoints, along with today's discussion, will help to provide a solid foundation as we begin to deliberate various aspects of the state budget. Thank you for being here today, and I look forward to hearing your comments.
Thank you, Senator. Now we'll return over to Senator O'Meara.
Thank you, Blake. Good afternoon, everybody. It's a pleasure to be here. I want to thank our economists on the panel that are going to be testifying for us. We appreciate your input every year on this. This year, the Senate minority, we have come out with a bit of a reduction on the expectations the Department of Budget did, with a lower expectation of about 0.3%. With that, largely reflecting concerns over slightly weaker than projected estimates on payments on personal income taxes and lower sales tax and use tax collections at this point, but partially offset by stronger than anticipated business tax collections. So we believe it's better to be a little more cautious at this point in time, particularly with certainly the federal government reset that we're seeing, both nationally and on the international stage, and how that could potentially impact our revenues going forward. So we're more cautious than optimistic at this point, but things are looking generally good. So we're close. Thank you.
Thank you, Senator. And Assemblyman Ra.
Thank you. There's no light here, so I couldn't tell whether it's on or not. Thank you, Budget Director. Great to be with you and my colleagues, and I'll share your congratulations to our new chair, who at the end of the day today will have a full series of budget hearings under his belt, and he's doing a great job. Thank you to our panelists for being here with us today. It's always very interesting to get your take on where we are, and obviously, as my colleagues have mentioned, there's a lot of factors at play as we look through this budget process. Last year, one of the things I highlighted was the concerns about the cost of living in our state. Affordability continues to be one of the most significant challenges facing families across our state, impacts their ability to cover essential costs, including housing, healthcare, education, everyday expenses. So I am pleased that the executive budget proposal does recognize the importance of affordability and even has incorporated some initiatives that are very similar to initiatives that have been put forth by our conference over the last few years, including in areas like childcare. I will say, as we go through this process, all of these affordability initiatives could really be, or their impact could be wiped out if we're not careful and we start talking about, increases in taxes and things of that nature, which taxpayers of the state can't afford. We need to reverse the trajectory that we have of the state in terms of losing population. We continue to have a budget that has a long-term structural deficit, and I think that it's essential that in this budget process we try to make sure that all of the great investments we're trying to make aren't ones that end up on the chopping block down the road. So I'm interested in the panelists' analysis on the state's economy concerning these topics, your analysis on federal economy regarding affordability, Federal Reserve monetary policy, federal government policy, and budgetary changes, as well as the labor market and unemployment levels. Thank you very much for being here, and I look forward to working with the executive and our other legislative conferences in an open and transparent budget process that puts New Yorkers first and provides us with an on-time and responsible budget.
Thank you, Senator. I'll turn it over to our Deputy State Controller, Maria Doulis.
Thank you. Thank you, Director. Thank you for convening us here today, and thank you to the panelists. Their perspective is always very, very helpful. I think I'd like to underscore what is a common theme through all the remarks that we have heard today, which is the uncertainty regarding the economy and federal funding. The budget is in this unique place where, after years of benefiting from extraordinary pandemic relief funding, the relationship between the federal government and the states may be poised to change in fundamental ways. That could include cuts to funding that back many essential programs in our state, especially in health and social services. The Comptroller commends the actions that have been taken in recent budgets to bring rainy day reserves to historic highs, and he supports the executive proposal to continue to increase the balance in the statutory rainy day reserves. These funds can help ensure the stability of services and are a key part of what should be a cautious approach to budgeting this year in order to protect the programs that New Yorkers rely on. So thank you. I very much look forward to the presentations and to the discussion today.
Great, thank you, Maria. So, I think we're gonna call an audible here today. It looks like the hamster on the wheel is getting internet up to speed here, wherever that is. So we're gonna start with Professor Lahiri, if we could, if you're amenable to that.
Sure.
And while we're getting our internet connection up to snuff, love to hear from you, Professor, and just take it away.
Thank you very much, and inviting me here. What I'm going to do is as you know, I have developed in SUNY Albany a forecasting model for state revenue involving many parts and using as much data as can possibly be downloaded and put it in a model. And then we input the data and the forecasts come out with very little intervention from me or my students and so on. So it's a very data-based forecast of state revenue forecast. Now, also this work, I have been presenting this for a few years now, have been developed in conjunction with many of my colleagues and students around this place. And so I thank all of them for input, data, and the basic way say the budget director thinks, his staff thinks, how things put together. I've been trying to mimic your thinking process over the years, actually, frankly speaking, in terms of econometric model, okay? What I get eventually is the estimated uncertainty of this forecast that you cannot get otherwise. That's the key. And you can see that these days, with this uncertainty looming, that whatever we say as a number, what's the underlying uncertainty is of paramount important, and that's I'm going to emphasize that today, okay? Now, and this work I've been doing with a previous student of mine, and he's now in China, but we keep on working together on this. So the way it is that we forecast year-over-year growth, so our revenue yearly, but we forecast in real time. So whatever data comes in at whatever point, we'd like to input them in our model, right? So that's called high frequency inputs. It can come in weekly, it can monthly. Whenever it comes, you can put in the model and the model handles it. The right-hand side, high frequency data, but predicting only one thing, which is the annual year-over-year growth in revenues. And our target is the tax revenues that our tax department puts out. If the DOB does anything slightly different, we don't do it because we are modeling the state tax revenue that comes out of the tax department. Okay, so sometimes there's a little difference in the definition and so on. Like comptroller, your definition is slightly different, DOB is slightly different, but those are not that big a deal. We can handle this, and. So the key is that we have a mixed frequency model. So we have annual data, weekly data, monthly data, quarterly data, and the model kind of puts all of them together. And that's a recent methodological developments. And let me get on with a few things. 2-3 years ago, we did publish a paper, our first pass at it, in terms of a machine learning language. We did the same thing. And since then, we have been developing this model over the last 3 years continuously as new data come in and so on, okay? So this work has been peer reviewed. That's the most important thing. It's not something that local I do and I try to sell you. These are analyzed purely internationally. They see how important or good the frameworks are. Now, as you know, I'll just show you a few indicators and how they have been behaving over time, and how they have jeopardized our capacity to model. After the COVID, the initial claims went to shoot up, and all econometric models failed. They couldn't handle this huge shoot up in the initial claims, but it has come down and it is at the level. I mean, not a big deal. There's something, Combined Transportation Service Index. As you know, I have developed from SUNY Albany. It is put out by the U.S. Department of Transportation every month. And it so happens that transportation index is very important as an indicator of economic activity. And so this is a national index that you know that after the COVID, it has come back to its original and it's chugging along. Leading economic index, of course, of the conference board is a big thing because it uses many variables and predicts the national economy, right? And you see that all these variables, some are coming down, some are going up. So all of them together, they give mixed signal as to what is going to happen to the New York State tax revenue. And that's our main business here, right? So now this is another thing that nobody has used it. It is the New York, New Jersey, Pennsylvania, the index of traffic across the bridges. It's a very important indicator. It shows the activity around state of New York. It comes from many trucks come from Canada and it travels through, and you see the activity, how they're moving around. And this truck traffic, particularly around Port Authority area, turns out to be a very important economic activity, and it represents a lot of things. And you can see that this has an uptick after the COVID period. New York State, electricity generation, it has a slow downward trend, but it has stabilized after a while. So another variable people look at it is average consumer expectations, right? Last month it fell, it made big news, but even if it fell by 5 percentage points, you can see in the context that it is on the uptick. It is slowly going up, actually, after falling a couple of years ago. So now New York State coincident indicator, there's a, for state of New York, it is put out by Philadelphia Fed. And you can see that is also going up steadily. And the other one that a lot of people look is the blue chip average forecast for real GDP for USA. And it fell 2-3 years after the COVID, but then it is slowly going up. So that's good news at the national level, right? Another thing that I'd like to draw attention is economic policy uncertainty. This is something that a lot of economists have been looking very seriously, that how uncertainty in impending economic policy at the federal government actually creates a huge problem in real growth. Okay, this is a big deal in economic science, and comes out of Stanford University, and you can see that this economic policy it is shooting up. You can see after the presidential election and so on, there's a lot of uncertainty as to what's going to happen, and everybody's uncertain, and that people have studied that has just that uncertainty affects economic activity badly, real economic activity, just a pure psychological uncertainty of something. Okay, that's a fact, and so this variable is also in my model. Another thing that it has been recently developed. This graph actually represents the systematic stress for an impending recession. So when it goes high, it means economy is getting into a recessionary risk. Okay, and you can see that it is not bad. It's very low currently. Now this is the variable we want to predict, right? This is the New York State Tax Department variable. And what you can see is that after a while, this has become really very volatile. This is one thing that creates a problem for forecasting revenues, but you can see that it is going up and down, and this is not ending. It's going to even increase more in a couple of years. So that's a big challenge. It increased after the COVID, but then it fell, and there are always a lot of reasons why it is going down, going up, and so on. It's very complicated, as you know, to predict tax revenues because it involves psychological, how households react to impending taxes and so on. That's very real. They pay the taxes this year or the next year. So this intertemporal transfer of this tax happens a lot, and it's very difficult to predict those behavior of the households, right? And of course, you know this. And these are all the list of variables that we put in our model. There are too many, but there are a lot of new variables that people don't use. Okay, have not used. I can very confidently say this. So we took a lot of time in putting together numerous New York State variables, U.S. government, variables and stuff like that. Okay, so there's a long list, and so what do you do? Because we are handling so many variables, you cannot put 500, 600 variables in the model. So what people do, they find out one factor or two factor out of 500 variables. So that's called composite factor. So for example, this is the US composite factor that comes out of the model. One variable representing hundreds of them. Okay? And you can see how it goes and how cyclical this composite factor is, and how during recession that it falls. Okay? Now this is New York State factor based on New York State data. Now this is also something new, and what you found out that the cyclical movements in New York State is not the same as cyclical movements in the US economy. It varies from recession to recession. So we had a special variable just for New York State cyclical growth in the economy, okay? Even though they are very similar, but not the same. Now, because I've been reporting this, you can see how our model works. We start forecasting 18 months before the end of the fiscal year. Okay? So we are making a monthly forecast 18 months before, and every month we move on in real time. And right now, for example, this is February, right? So we have started forecasting 4 or 5 months ago when the governor prepares the budget. We are ready, actually, you can see. And then, so if you look at this, so we forecast 18 months before and slowly move forward till the end of the fiscal year, which is March. So the 18 months we are forecasting continuously in real time. Okay, as new data is coming in, we have a new forecast. For example, our forecast that I'll present has 1 or 2 more months of data than the forecast that was put out by DOB. DOB has done 1 or 2 months ago, right? And that's the flexibility of the model, that I can input, a new thing happens, I can input in my model, and it revises the forecast, okay? That's the advantage of these kinds of model. And you can see that what happens is that the red line is kind of a forecast that you'll get out of a standard mundane time series model, just based on time series forecast. And this is the year 2010. You see, when I did it, it showed a negative growth right from the beginning because you have a lot of factors. That's the blue line, okay? But a ad hoc forecast would have over forecasted it. Then, of course, eventually it gets to that thing that happened, which is -5%. This is just an example, okay? So I don't want to sort of bore you with a lot of details, okay, gory details. A lot of math goes into the picture, That's what I do in the universities, right? But the question is, what's the bottom line for you folks? Okay, I'm aware of this. And so, as I said, I use a lot of inputs from NASBO, DOB, Ways and Means, Finance, Urban Institute. We collect information all over the places because I have a lot of friends and students all over the places. So that's my source of information. And recently what I did is we have a policy change variable for state of New York that represents the anticipated effects of a tax policy in the future. Okay, this is a new variable we call policy change variable, that we have worked for the last 1 year, and this is something new. So this tax policy variable that I collected data from, DOB experts and NASBO experts, and the yellow line is the tax policy, and the actual tax is the blue line. So it predates it, okay, nicely. So these are all in the model. This is our complicated statistical model, very complicated. But this is the thing. It has 3-4 different segments. One from the New York State factor, another is US factor, the actual time series of taxes, and our policy variable. All these 4 variables we combine to get a final forecast, okay? So they're weighted average of the forecast, so I'll give you for the last 3 years, this time I generally give you out a forecast, right? Now, we don't come back and see what I was saying and what actually happened, right? So this time I put 3 graphs there. So where am I standing? I'm standing, this is now February. So February 2022, I was here, and our forecast was, you can see, up. Okay, and then the green line is the actual that happened by the end of the fiscal year. Okay, so when we make forecasts, we don't know. Like when DOB is making forecasts, of course, it doesn't know what would happen. So they made a forecast now, say in January. One thing I'll draw your attention is the band is the uncertainty of the forecast, and the uncertainty reduces as we come to the end of the fiscal year, right? So right now, you can see how much is the uncertainty. Whether DOB put out the forecast or I'm doing the forecast, no matter who gives what forecast, there's an uncertainty. And if you don't accept that, you're living in a fool's paradise. It's as simple as that, okay? So you can see that how big the uncertainty is right now. When you're making the budget, you have a huge uncertainty. And that uncertainty gets resolved very quickly. By the time of your midterm budget adjustment, you see it has become really narrow. At that point, you have solid data, very certain data that what's going on, because you're already 6 months into the fiscal year. You know what's going on. But when you're doing real forecast, there's a lot of uncertainty. And that uncertainty has to be recognized, I think. For proper decision making. This is 2024. So people started with a very high forecast, 2004, but it turned out the actual was much lower. It was a minus value. So you can see all of us made an overestimate for that fiscal year, but it turned out to be very optimistic, and you can see what the actual. It turned out to be a negative, actually. So that's that's forecasting, right? That you make mistakes, but the mistakes get corrected as you do repeated forecast in real time. Okay, that's the key. So at the end, you can see you are hitting the thing by July of the year. You get pretty much a good idea what's going on. Not before. Right now, nobody has a very good idea of what is going to be the total outcome. Right now, so last year, there's not much action that we saw. We made a forecast, fiscal year 2025, like 5-6%. Basically, that forecast didn't change as we do repeated forecast, okay? Because there's not much good news or bad news were coming in. This year, for the fiscal year 26, what we found out, we are making the forecast from a couple of months before. So till you can see the last year, forecast was flat, around 5%. But at the new year came in, our forecast steadily start going down. Okay, so last 3-4 months, the revenue forecast, somehow something is happening there out there that we are anticipating less revenue for the fiscal year. The bottom line in terms of numbers, you don't need to see this. I've done this. The bottom line, what you found out, and compared to the DOB forecast, this is now 14-month ahead forecast we are doing, right? By the end of the fiscal year. So the current 14-month ahead forecast for fiscal year 2006 is just 15%, 1.5% growth compared to the nowcast of this year. Okay, this year is not yet over, so we are now casting this year's growth. Given our nowcast for this year's growth, we are anticipating almost same revenue. We are not anticipating much growth at all. Our number is 0.15%. That translates into close to 110 billion based on our forecast. And this number so happens, which is pleasing, is very similar to DOB forecast. DOB forecast is around $6 or $10 billion more. The reason is our forecast doesn't include the PTET anticipation. Why? Because the tax department doesn't include that. And we have one target, which is what the tax department puts out, right? So if you add that your almost $6 billion coming from PTT, then actually so happens that our forecast is very similar right now with the DOB forecast. Very similar, it so happens. It's pleasing because we are coming from a completely different angle, and you folks are coming from a completely different angle. The whole mechanics is different, and we almost hit the same. It doesn't happen every year, but this year is there. But the uncertainty behind it is big. I showed you how big the uncertainty band, and that we have to deal with when you do forecast. And what it is that have a lot of rainy day funds. I have been keep saying this for a long time. Build up as much as you can, because what is coming, we don't know really. Completely uncertain, right? And if at all, New York is going to be hit badly, worse than other states, right? So we have to get ready. Like I work in SUNY, we are getting ready. A lot of our NIH grants and so have been already cut. So we're in like $90 million shortfall in a SUNY budget, huge. So it's going to hit you also some ways. So my suggestion is that be careful, don't destroy already enacted programs, right, to protect them. And for that, the budget forecast is so important. So by this, I'll stop. And later, if you have any question, I'll be happy to go details into it.
Well, thank you, Doctor. You said that you have friends and students all over the place. Many of those students are here in this building, so it's always nice to have you join us. I for one, am looking forward to maybe next year looking at some of your traffic data, certainly with congestion pricing and how that might have modified some of those data in the interim. So we are, I think we're getting close to perhaps getting our folks back online here. If this works, I'm gonna pause for just a second or two. And look at that. Through the miracle of modern technology, we are joined once again by Drs. Tara Sinclair and Hugh Johnson remotely. And I know that you were able to tune into Professor Lahiri's comments as well. So perhaps we can just jump right in to Dr. Sinclair. If you want to share your thoughts, we're looking forward to hearing from you.
Great, thank you. It's such a pleasure to be here, and it's wonderful to hear some of Kajal Lahiri's work. It's good to see you and hear about your latest work. It's fascinating. So let me just share my screen here. All right. And so let me just jump right in because I think both some of y'all's opening remarks as well as some keywords from Kajal's presentation really link in very well with the overall U.S. macroeconomic outlook. So one of the keywords that we were hearing a lot about 2024 is resilient, and that's a really good place to be entering into 2025. However, we are using a new keyword for 2025, which is uncertainty. And of course, coming into a world of uncertainty from a resilient place is pretty reassuring. But let me just go ahead and kind of give the big background of the talk for today. So as I noted, we've got a strong economy so far in 2025, particularly looking at the hard data that's available so far, but an incredible amount of uncertainty looms. I saw that Professor Lahiri already showed the economic policy uncertainty graph. You'll see it again in my slide. It's definitely something that economists are watching carefully. But as I noted, remarkable performance over the last several years does put us in a better position than we could be if we were entering this year of uncertainty in a weaker position. So we're starting out with broadly healthy macroeconomy based on the most recent data. I will quickly show you some charts that GDP growth is strong, unemployment is low, and inflation has cooled but is still above the Fed's target. But the risks have really grown. And so I want to highlight a number of risks. Obviously, we're going to need to talk about higher, longer run interest rates, shifts in the housing market, uncertainty, there's that word again, about policies from the new administration, and just more uncertainty about the macroeconomic conditions writ large. And then I also want to mention briefly something that could be a risk on either side, thinking about potential for disruption from artificial intelligence advances. Let me just jump into some charts here. So first of all, I think it is still really an important point to look back at the US economic performance over the last several years. And we can think about it comparing it both to other similar advanced economies, as well as to what forecasters expected in terms of our economic performance. And from either perspective, the US economy is just really outperforming. So the chart I'm showing here is just showing that the US economy is just really performing well above other advanced economies, and that's putting us in a good position, and that's coming both from stronger demand. The U.S. consumer and the U.S. household is doing well and spending, and that's a good sign on that front, as well as business investment. But we're also really benefiting from stronger supply, and that's coming both from gains in labor productivity, but also gains in labor supply that we've seen from increased labor force participation, as well as increased immigration over the last couple of years in particular. But we're not sure either of those trends is going to continue. The US labor market does remain strong, and forecasters expect continued low unemployment. So right now we're a couple tenths below the Fed's longer run estimate of unemployment. The US is at 4.0% unemployment, the Fed's at 4.2%. And forecasters over the next several quarters are expecting it to rise perhaps a few tenths, but really stay remarkably low in historical context. But I think it's important to note when we're talking about the labor market that there's little room for further employment gains because we're looking at expectations of limited population growth, and that's going to mean slower employment growth going forward. We've gotten really used to this idea of 200,000 net new jobs created on average month over month, but that's slowing. And if we follow what's expected, for example, in this chart from the Congressional Budget Office, we're expecting a notable slowing in US population growth. And along with that, we're also continuing to see aging of the population. And that means that we're swiftly looking at seeing gains less than 100,000 a month being still consistent with the unemployment rate staying low. And so there's just not a lot of sources for strong employment growth. And without that strong employment growth, we're also looking at weaker supply gains overall for us to be able to continue to grow the economy. On the inflation front, so it has cooled notably, although prices remain elevated, and obviously that is a concern across the country. And now, in addition, inflation is expected to be above the Fed's target into 2026. That's a pretty notable shift from even just a couple months back, where forecasters were expecting inflation to be back at target sometime in 2025. That's been pushed out a bit. But I think these forecasts are incredibly uncertain, and there's been a lot of movements around both inflation and growth forecasts, depending upon where and when policy impacts are expected to come in. And so that really connects into that uncertainty view going forward. Interest rates, we're now looking not just at higher for longer, which has been something we've been talking about for a while in economic forecasts, but the recent Fed forecasts also suggest that the interest rates are expected to be higher in the near term. So if we just compare the FOMC, so the Fed's Open Market Committee projections, the median in September versus the median in December, it's higher across the board for this year, for next year. And perhaps most concerningly, also, it continues to tick up for the longer run. And so with those higher interest rates, that's kind of the necessary consequence of expecting inflation to be something that we're going to continue to need to see the Fed battling. But those higher interest rates are going to cause continued affordability concerns, particularly around housing. So if I transition to talking about housing affordability, that is down dramatically since 2021, and that is very much associated with those higher interest rates that we've seen with the Fed fighting that inflation surge that we saw in 2022. So what I mean by housing affordability is we think about a median income family, they can no longer afford a median priced home. And that drop has really been quite dramatic in the last few years. And so when we hear that families are struggling with housing, that's a real concern that is going to continue to be a challenge, particularly with persistently high interest rates. And housing supply is, of course, one way to address this. We could build our way to affordability, but it's going to take a long time because housing supply is a long-run problem. If we look at our patterns about new residential construction, we may have been overbuilding somewhat, so we might have seen that increase in construction as we went into the great financial crisis, but then the response to that and the drop-off to that has been extreme. And we've really seen relatively little construction relative to the needs for our demographics for many, many years. And therefore, that's setting us up for a continued supply crunch on housing. And so that combined with those higher interest rates is making it particularly difficult for households. We have seen some expanded construction in apartments over the last year or two or 3 years. But it is still the case that that is now dropping off. And so the improvements that we saw in terms of rent affordability may be struggling going forward because home builders are also facing those higher interest rates. And so some projects just aren't penciling out for them. And so if we don't see new construction, then we don't see that new supply coming on board in the next couple of years. Back to the theme of uncertainty. If we think about that same index that Professor Lahiri showed a few minutes ago, I just want to reemphasize what he said, that this policy uncertainty has been shown in economic research to lead to decreased investment, hiring, spending. And so increased uncertainty on the policy side is a challenge and a literal cost for both consumers and firms. And so this is something that I think is not just indicating that there are risks on the horizon, but it itself is a risk as well, because that uncertainty can slow decisions. And if we see slower hiring, slower spending, that can have a direct macroeconomic impact, as well as reflecting concerns about other shocks that could hit the economy and cause other damaging impacts. One particular piece that I wanted to highlight that I think maybe is underwatched is what's been going on in terms of the value of the US dollar. So the US dollar index is near record highs, and that means that we could see corporate earnings, particularly in tech, be curbed, and that has impacts here at home. It obviously impacts our exports more broadly, but particularly it may lead to firms reducing their investment as well if they're not able to access the international markets at an affordable price. But on what I consider to be the potentially good news, bad news story, the particularly big, wide uncertainty bands come when we're thinking about artificial intelligence. We continue to watch, and different researchers have come up with widely different estimates of the potential macroeconomic impacts of artificial intelligence advances over the last couple of years, what they're going to do over the next 10 years. And so we can go from very optimistic impacts that it might basically more than double our productivity, down to it having a very, very small impact, to near indistinguishable from zero impact on our productivity. And so this is an area where economists are watching what's going to happen in terms of AI's impact on productivity, but also whether it's going to be complementary to our current workforce or whether it's going to be disruptive. And it's probably going to be a mix of both of those things. And so even if we do get some of these bigger productivity gains, it may still have real adjustment costs for households and firms as they transition to using this new technology effectively. And that may still lead to macroeconomic costs in the near term, even if in the long run we do see some pretty substantial productivity gains. And so it's something where I think just really wide uncertainty bands, and we can have some optimism essentially in the long run, but be prepared for costs and challenges in the transition. Let me just sum up here. So the base case, so what we're thinking of is kind of like the where we're starting from is still a sense of slow cooling if we just follow on the macroeconomic data and kind of these built-in data patterns, coming back to kind of our long-run trends is that base case, but there's notably wide risks to the outlook, and those risks are to both sides, although I admit that in recent conversations, I've been definitely watching out for the downside risks, because I think those could be large and dramatic, whereas the upside risks, I think, could just be a little bit faster growth, a little bit more pressure on inflation. So I think that's something to kind of keep in mind in terms of the weightings. To sum up, we've seen remarkable U.S. economic performance over the last several years, and that puts the U.S. economy in a better position to weather future shocks. But we are facing that growing uncertainty, and that's coming along with those additional risks on the financial side, on demand side, on the supply side. I highlighted the economic policy uncertainty. I also pointed out some short-run inflation risks and long-run interest rate risks. But there's a lot of other risks that are hiding in the background that I want to mention, but are challenging to quantify at this stage. We're continuing to watch financial risk from commercial real estate. That seems to have kind of gone into the background for now, but we're still facing future maturity walls that may result in some risks, particularly in some areas, perhaps less so in New York, given the type of banks that are lending there. But in more rural areas, actually, there may be some smaller banks that are more exposed to commercial real estate. We've got fiscal sustainability concerns. We've got the deregulation may look good in the short run, but if it doesn't protect us from the next big shock, then it may be very, very costly at that time. We always have to keep in mind that there is always lurking recession risk, even in the best of times, where we need to keep an eye on that, because recessions are in general unforecastable. And so they can crop up if we're not prepared for them. And then I highlighted supply side risks from artificial intelligence, that we continue to face climate supply side risks, health, bird flu is something that we need to keep an eye on. And the geopolitical tensions, and the climate, health, and geopolitical tensions all are really downside supply side risks. The AI could bring some upside. So I'll stop there, and I look forward to the future conversation. Thanks.
Well, thank you very much, Dr. Sinclair, for the insight. Next, we'll move along to Hugh Johnson for his to share some thoughts as well.
Apparently I muted myself, which is probably a good thing. But nevertheless, let me give you some of my thoughts. There's been a lot of discussion by Professor Lahiri and also by Tara, and they're really they've been both raising some very important points, but it's been very comprehensive, giving you enough to really think about. I'm going to start. I was thinking about how am I going to start and at least stir some attention. And I'm going to start with a quotation, and it's very worrisome, but it's also something that I think we all ought to simply think about. I think I'm simply saying one thing, and that is I've been doing this for a number of years, talking for a number of years to you about the forecast for the national economy, the New York State economy, and even spending some time on revenues. Making a forecast for revenues, which I wouldn't pay a lot of attention to, but nevertheless, I keep doing it. And I'm going to do that again this time. But importantly, I think that of all the years that I've been doing this, currently, the risks are far higher than I've ever seen in our forecasting sessions before. I have one quotation, and it's very worrisome, but it's worth just mentioning. And this is from The Economist magazine about a month ago. And they state, before the fight against fascism convinced FDR that it was in his country's interest to help bring order and prosperity to the world. The country was hostile toward immigration, hostile towards or scornful of trade, and skeptical of foreign entanglements. In the 1920s and 1930s, that led to dark times. It could happen again. What I'm simply saying is that the risks now, I think, are higher than at any time that I've seen. Now, I think there are significant dissimilarities between the current period and the 1930s or late 20s, early 30s, and that I don't think we're going to see, I'm hopeful that we're not going to see a repeat of the outcomes of 1930s. But I'm simply stating that I think in your deliberations about budgets and revenues, I think you have to recognize, I think it's important to recognize, I'm not being hysterical, I hope I'm not, to recognize that because of policy changes primarily that are occurring in Washington, and they are very significant, that I think you have to be a little more aware of the risks that we face. I'm gonna just touch base. I've given you a handout, or you all have a handout. I'm gonna be skipping around a little bit, but trying to follow some order in the handout. I'm gonna start on page 2. Those of you who have heard me before know that I have 2 important steps that I take in trying to tell you or give you my sense as to what lies ahead. And to some extent, I'll try to quantify what I think is going to be the outcome, although consistent with what Tara Sinclair said, the level of uncertainty, risk is very high, and the level of uncertainty is significant. So I would look at my quantification of what I believe is going to be the outcome for 2025 and 26. But I would, I don't want to say treat it gingerly, but I would say recognize that the levels of uncertainty in the forecast or the risk associated with the forecast are fairly significant. The 2 steps that I follow, which are important to me, is I look at the performance of the financial markets as step 1. And the reason I do that is because investors, it's been my experience that investors tend to get it right. Now, what they get right is investors collectively, not individually, but collectively, tend to understand what lies ahead for the economy, earnings, inflation, and interest rates. That is, they understand, or they seem to get it right, as to where we are in the current cycle, a cycle which consists of 3 parts: an economic cycle followed by or accompanied by a stock market cycle. Let me say it the right way. A stock market cycle followed by an economic cycle and followed by an inflation and interest rate cycle. The performance, the financial markets tend to perform in ways that reflect where we are in that cycle. And I think that's still the case. The second step in the whole process is to identify important trends that are unfolding in the economy, monetary policy and fiscal policy, to determine if investors collectively have it right. The performance of the financial markets has been, if we take a look at performance for the 4th quarter of 2024 and the 1st quarter, what we have of the 1st quarter of 2025 has been very positive. It's been positive insofar as the stock market is up. The so-called bull market sectors, or economically sensitive sectors of the market, to include things like consumers' discretionary, technology, Equities, industrial equities have outperformed the so-called safer sectors of the market, such as utilities and consumer staples. Growth stocks have outperformed value stocks. In the credit markets, we see the difference or the spread between yields on investment grade corporate bonds and 10-year treasuries has continued to narrow, reflecting the fact that investors are optimistic about prospects for the economy. So the performance of the financial markets or investors collectively are sending you a message, or sending us a message, and that is that prospects for the economy and earnings, inflation and interest rates are indeed positive. I'm going to mention a word of caution right here, and that is this seems to be shifting. We have shifted from the investors sending us a fairly positive message. For the last couple of weeks, they've been sending us a somewhat concerned or negative message. In other words, the so-called bear market sectors, the so-called safer sectors of the market, are now outperforming the more volatile bull market sectors. That's troubling. Growth stocks are no longer outperforming value stocks. It's now the case that value stocks are outperforming growth stocks, and the spreads between the yields on both investment grade fixed income securities, as well as 10-year treasuries, as well as the spreads between below investment grade securities, fixed income securities, and 10-year treasuries are now starting to widen. And that's starting to evidence, and it's only a short period of time, a couple of weeks, 2-3 weeks, in response to some of the numbers that we've been seeing. But that's the primary reason why we're starting to see a shift, suggesting to me that some of the risks that I'm going to get to in just a minute, such as the risks that are associated with the Trump tariffs, might be becoming taken seriously by investors collectively. If we ask ourselves the question, leaving the shift that's going on in the financial markets aside and looking at the performance in September, if we ask ourselves, is that performance rational? Is it consistent with a rational forecast for the economy and earnings? I would have to conclude, and I want to be brief here because we have a long discussion about monetary policy and fiscal policy that we probably have to cover, but I'd say that it is rational. It's hard to believe because in 2023 and 2024, really till the end of 2024, till September of 2024, monetary policy was moving towards or shifting towards restraint. The Federal Reserve was was increasing its holdings of financial assets, and the federal government in Washington was also reducing, not increasing its policy. In other words, its spending. What was surprising, which was mentioned by Tara, is the performance of the economy was indeed really pretty good, surprisingly good in 23, 24, and we'll see about 2025, although I think, as Tara also mentioned, there's pretty clear evidence, or somewhat clear to me, that the economy is in the process of slowing, or it's slowed in the fourth quarter, and as we start 2025. And so the question has always come up, is that if you have, first of all, a slowdown, a significant slowdown in the growth of the money supply, how is it the case that we were able to perform so well, or the economy was able to perform so well in 23 and 24? The answer actually comes from a former professor at SUNY who used to look at me and say, Hugh, you've got to understand velocity. It's velocity, Hugh. In other words, although it's been the case that the money supply has slowed to negative rates as we finish 2023 and 24, although it's slowed to very slow rates, velocity has increased, which is normal to expect that when inflation expectations are increasing or are as high as they currently are. Spend the money fast because next week it's going to cost you more. That's essentially the theory. So we've had good performance from the economy, but I think that there's evidence now that the economy is in the process is in the process slowing. In the handout I've given you on page 3 and page 4, I give you a summary of what I take to be a rational forecast for the outcome for all sorts of variables for the national economy and the New York State economy. I'm going to skip by that, and then if we get to page 4 and beyond, you get to details of that forecast. And the forecast essentially says this. It says that the economy has been or is in the process of slowing, and it should continue to slow as we move through 2025 and probably improve or start to pick up in 2026. I quantify that forecast, and that's important, at the bottom of page 4, and as well as the top of page 5, 6, and 7. So the economy would be in the process of slowing. Inflation, I think this is effectively what Tara was getting at, is it looks to me like it has stalled out. The declines that we saw in the rate of inflation in 2023 and 24 has stalled out. And the evidence is that we're going to start to see, it's not only stalling out, but we might see, I call it a modest increase in the rate of inflation as we move through 2025 and 2026. So the economy in the process of slowing, and in addition to that, inflation either staying stalled out or maybe even moving slightly ahead. And that's contained in some of the tables that I give you. As I say, the tables quantify effectively what I'm trying to say. The question is what will the Federal Reserve do in response? My answer to that question is, I think and a lot of people think this is controversial. I think the most important thing to Chairman Powell and his, I say this somewhat in a critical way, but I shouldn't say it in a critical way, is his legacy. And his legacy is being able to bring inflation down without creating a hard landing. And I think preserving that soft landing, or that the economy continues to expand, even though inflation isn't at the 2%, it's down fairly close. Preserving that, I think, is very important to him. So my guess is, and this can only be a guess, believe me, this is a guess, is that there'll be one reduction in the federal funds rate, or the Federal Reserve will reduce interest rates one time in 2025 and one time in 2026. Although I notice now, in response to the weaker numbers that we're seeing, not just simply primarily for December, and also I would emphasize January, that we're now starting to see that the consensus forecast among those that do this sort of thing is that there'll be 2 reductions in interest rates in 2025 and 2 reductions in 2026. This is very, as the Federal Reserve will tell you over and over again, data dependent. So we'll take a look at the numbers as they come in, and you can imagine, you can bet that the Federal Reserve policy, or what's ahead for Federal Reserve policy, the expectations is going to shift as we move through 2025 and 2026. If the Federal Reserve reduces short-term interest rates, longer-term interest rates are going to come down. That's quantified in the tables that I give you. And as longer-term interest rates come down, stock prices will do well, although stock prices have moved to a level, in my judgment, again, this is more we would call fun with numbers, but the stock market is at a level which, in my judgment, is overvalued, 7.3% overvalued, who knows, above the level it should average in the current quarter, but 12% below the level I have it as averaging in the fourth quarter 2026. So prospects on a near-term basis may not be good, using a sensible forecast for the economy, but on a longer-term basis are very good. The big problem, as you can well understand, as I said before, there are 3 significant risks to the U.S. economy. Tara mentioned employment. The growth rate of employment is not going to improve, particularly with deportations. I've included a lot of numbers on the situation with regard to immigration restrictions or limitations and deportations. And that's not good news for the economy and will put downward pressure on economic activity. The second, of course, worry that you have to have is the budget. And the budget includes the expectation or the request, I don't know if you call it a request or a proposal, and that is that the Tax Cuts and Jobs Act of 2017, in addition to taxes on overtime, taxes on a number of other taxes, Social Security will be reduced, or that the Tax Cuts and Jobs Act of 2017 will be extended beyond the sunset of 2025 or the end of this year. The Congressional Budget Office estimates that those tax reductions will increase the federal budget deficit by $3 trillion and will increase debt service payments by $467 billion over a 10-year period. Those increases have to be financed. In the past, we've financed about half of that with foreign capital. If you're increasing tariffs at a time you're trying to finance deficits with foreign capital, it's not going to be easy. It may be a little bit, we may have to raise interest rates, or interest rates may need to go a little bit higher in order to finance those deficits. I don't know. But nevertheless, that's what it implies. It's going to be, let's say, a challenge. If you look at the numbers, the Trump administration, and I don't mean to be political, but the Trump administration wants to finance the loss of revenues from tax reductions with increased revenues, excise tax revenues. And if you look at the numbers on the 2018-2019 trade war, you'll see that those numbers just don't add up. You can't do it, is what I'm simply saying. I've incidentally also included numbers on the impact, or all what happened in the 2018-2019 trade war. And as you might expect, inflation during the first 6 months of that trade war increased fairly substantially. I also include in here a forecast for New York State, for New York State's economy, for New York State's employment. And I also include a forecast which I think should be taken lightly, which is a forecast for revenues in New York State. I can't get the numbers to work, quite frankly. Overall, what I'm simply saying is that I think you got a lot of information from Professor Lahiri, a lot of information from Professor Sinclair. I think it's useful, it's valuable. I'm just sort of adding my 2 cents. And what I'm simply adding, which is the most important thing I'm adding, is that I've quantified the forecast. Hopefully that's helpful to you. What I'm simply saying, which is the most important thing I'm saying, is I think the risks that are associated with what you have to do with regard to the 2026 fiscal year budget, I think is very challenging, and primarily challenging because I think the risks this year are higher than I've ever seen. Well, certainly higher than I can remember seeing. And if there are any questions, I, like Professor Sinclair or Professor Lahiri, are more than happy to try to answer them.
Well, thank you, Mr. Johnson. I think I speak for every person on the panel here in saying that we hope you're wrong in the first statement on the quote from the Economist. Obviously, these are heady times, but we have I think we all have to do our part to make it a little bit better. So again, but point well taken. One thing just dawned. We'll start questions now, and sort of dawned on me. I think Mr. Johnson touched on some of these things already, noting some of the risks, employment, the budget generally, tariffs. Policymakers in Albany trying to separate the signal from the noise of what's coming out of Washington. Trying to just determine what are the things perhaps that keep you up at night. What's a policy change in Washington that keeps you up at night? Of course, spending retrenchment and lowering, lowering headcounts in federal agencies are certainly big problems in certain jurisdictions. Certainly, broader spending rescissions are a big problem in the state of New York. Are there any particular policies, any particular tax issues that really just sort of like almost like a canary in the coal mine? What are the things that really kind of, if we hear that coming out of Washington, should we be on alert for?
My own feeling, and I look forward to the others, what they have to say. I worry about them all. I have some people are friends in Washington, and I try to keep on top of the one issue. And of course, immigration and deportation is very significant. The layoffs, the layoffs obviously are terribly troubling because they may be characterized as being somewhat inhumane. And that would be my opinion. I also spend a lot of time trying to figure out and this is very important, is whether the tariffs, whether we are going to see action on the tariffs, or it's going to be somewhat similar to 2018 and 19, where they're really being used. The threat of tariffs is being used as a negotiating tool. People that I talk to in Washington believe strongly that it's just being used for negotiation purposes and that we will not see the tariffs. I don't believe that's true. I believe it's true that we will see action. As you know, the president has said that he's going to go through with, on March 4th, I think it's March 4th, he's going to go through with the 10%, I believe it's 10% tariffs in Canada and Mexico, and another 10% on China. I think I take them seriously. I think it's not just for negotiations. It's for sure, or it's actionable. It's going to happen, and obviously the impact of the tax reductions in the budget, and all of that adds up to the significant risks. Inflation will be higher because of tariffs in the first 5 or 6 or 7 months of the tariffs. And it also means that there will be a downward reduction in the forecast you see from me on the U.S. economy. So you've got some numbers for me, 2.3% for 2025, 2.1% for 2026. Those numbers are going to have to be reduced if indeed the president or the administration goes through with the tariffs that are being proposed, as well as the changes or the restrictions, limitations on immigration, as well as primarily the tax reductions for the Tax Cuts and Jobs Act of 2017 at the end of 2025. So I worry. The answer I should have given you was I worry about them all, and they all keep me up at night.
Spoken like a true analyst from the Division of Budget. So, Professor Sinclair and Lahiri, any other observations on that?
Yeah, well, let me jump in here, and so I agree with all the things that keep Hugh up at night. Those all keep me up at night as well. Let me add a few more because who needs sleep. So the first one, and I kind of highlighted this in my talk, but I think it's worth emphasizing more, is that one of the things that businesses have responded relatively favorably to is this idea of deregulation. And again, that might have some short-run economic benefits, but my concern is that depending on where we cut the regulation, it might have been brought in for good reason. And if it's done in an uncareful way and we lose regulation that is protecting us from another financial crisis, then I think that that's something that's putting us at more risk. There's also the real potential for some kind of fiscal crisis. As you mentioned, there could be greater debt, but there's also concerns about there might be additional concerns about debt limit crises and that sort of thing that could result in a downgrading of U.S. sovereign debt. And the markets may respond to that in a really perverse and interesting way, where they may actually lean more into that debt at a sign of global turmoil, because the good news for the U.S. is that there really isn't another safe asset to go to. But that could shift. It could shift quickly. It could be dramatic. It could be really, really bad. And so I think that we are facing a number of potential really big existential crises that we need to keep an eye on.
It's hard to put your finger on one of them.
If you ask me, one thing that bothers me of impending this is the tariff war. That economists have studied this over the last 150 years. Big people smart people have studied this. Nobody ever would tell you that that can help anybody, actually. So that's, to me, it's a kind of mad thing to think. And I hope it's negotiating tool, and it finally doesn't happen.
Fair enough. I'd like to turn it over to members of the Assembly and Senate. If you have any questions, please jump on in.
I'll have a quick question. When I first got on the Ways and Means Committee back in the late 90s, we used to talk about the wealth of New York State. More than 50% of the wealth of New York State was generated south of Canal Street. And most of that was generated through what we call FIRE, which was finance, insurance, and real estate. And I'm looking at the economy now and what these economists have talked about, and I see problems in all three of those areas. The insurance industry, since the meltdown several years ago, has leaving New York. The finance that we used to be driven on Wall Street, a lot of it moved across the river to Jersey City, and now I'm hearing that another segment is going to move to Dallas, Texas, leaving New York. And since the pandemic, real estate downtown has been abysmal, to say the least. But I do know that a lot of companies are requiring their employees to move back to the offices, but I don't see those offices being back to full occupancy anytime in the near future. Do any of you see any hope for New York in light of the drastic cuts that the current administration is talking about now in monies that New York State is used to receiving? Specifically, I'm talking Medicaid. We don't know how those dollars are going to be cut, but we do know they're committed to cut hundreds of billions of dollars out of the Medicaid. New York State gets a large percentage of that. And if that goes through, even if it's what some people have said, a minor cut to New York of $10 billion, that would be devastating to this state. And I don't know if New York State's we can't tax our way out of it. So we're going to have some serious problems. I did hear that, I think it's Maine, I don't know if we can do this, is going to withhold federal taxes, not send them to Washington and maintain them in the state. I don't know if that's even legal, but if it is, if we can make it a law, I would definitely sponsor that legislation because I think that what the feds are planning to do to us is going to devastate the state for a long time to come. So I don't know if any of the economists or all three of you have any comments to say on what I've just stated.
I wish I had an answer, and I don't. And I'm not sure anybody does have an answer. A lot of what you've talked about, well, part of what you've talked about is, of course, it has to do with investing and finance and Wall Street. And I think you're right. I think we're all right that we may go through, after having really good years, I think we may go through a difficult year. I hope it's a difficult year and not more than one. And I think in time, that will be fine. And I think there may be some movement by Wall Street across the river, and there might be additional movement. I don't know, to Texas. I have no idea what the plans are. But if Wall Street depends heavily, and it does, on the performance of the financial markets, I used to be told by my father, this is my old sort of at-home story. He said, keep in mind, it's time, not timing. That's the secret to success in the financial business. And I think in time, I think New York State will be just fine, or the financial markets will perform well, and it will be reflected in obviously bonuses, which are so important to the revenues of New York State. So I think I'm not worried about that. What you talk about Medicaid, it's obviously, I mean, this is for you to answer. I mean, this is it's been turned into a political issue, and I can't answer that question. You know the problem. I mean, I don't have to tell you I think I should keep my mouth shut on that one. I'm sorry to have to give you that kind of an answer. I wish I had some magic, but I don't.
Johnson, it's okay.
You know, my way of looking at it is that, say, New York State economy, because of the presence of major universities, high-class universities who do high-tech research, that in terms of AI and all that, you know, you have the Columbia, Cornell, Illinois, and so major, R&D improvement. That's what the economy regroups, right? I mean, the same old Wall Street is not going to continue. Things change, right? And the economy has a resilience. It does other stuff. And we cannot predict that, actually. High tech, like look how Albany has grown up in nanotech, right? Who could have thought this? And those are the angles where New York has to regroup in a different way, and it will, because there are entrepreneurs around, and not the government, but the private that's the only thing we hope. The population is leaving, we know. It's getting less. But my faith is in terms of high tech and the role of big universities that exist in this area that is going to sustain our growth.
Yeah, I'll just jump in. Just one caveat to what Kajal just said. So I think that's right in the long term. In the short term, universities are facing funding challenges. So that's something to keep in mind in the short term.
True.
I think I've emerged from my semi-comatose state after these presentations. Thank you so much. Dr. Lahiri, I think you're saying that you agree with the Division of Budget's revenue estimate.
Yeah.
Okay. And I think Mr. Johnson gave us budget numbers, but he said their numbers are very suspect. Right? Is that right, Mr.
Yes.
Johnson? Okay.
Yeah, I would.
It says,
Yes, that's the answer.
it says I think you said you wouldn't rely on these numbers.
No, I would not on mine, no.
Okay, so we can't rely on these numbers, and I think Dr. Sinclair didn't give us an opinion about the revenue estimate that we have from the Division of Budget, correct? All right.
That's
so,
right. That was in
Like you're one for three.
One thing is that my way of looking at it is a highly uncertain, okay? Just saying the numbers are bad, to me, doesn't mean anything. I mean, you have to have a quantitative assessment
No,
of the
I'm not
uncertainty.
asking for an assessment as to
And all of us
whether-
agree that it is highly uncertain, and this year it's more uncertain. I think all of us agree to that is a reality we face. Doesn't mean that the
Uncertainties
numbers are bad.
loom. Uncertainties loom.
Uncertainty of?
Uncertainties loom.
Yeah, absolutely. That is
Thank
there.
you.
I mean, I think all of us agree to
I
that.
should clarify that I feel very comfortable with my numbers for the national economy and for the New York State economy, including all the numbers, personal income, wages, the unemployment rate for New York State, the inflation rate for New York State, the New York State gross state product, which I've got in there, New York State employment. I feel very comfortable with all those numbers. When I go from those numbers to revenues, I don't have any comfort because of the statistics. The statistics tell me, Hugh, you're doing something wrong, and I don't know what it is. That's as simple as that. So, but let me also say about the other numbers, the state and the national numbers, is that the level of risks, as always, is very high.
Thank you.
I don't know if that makes any sense, but there you are.
Thanks. Thank you all for your presentations. I know there's some discussion of inflation, where it's been, where it stands. My following of inflation in at least the recent year or so is that the New York and northeastern region of the country has not had the lowering of inflation to the extent that other broader areas of the country has. I guess my first question is, do you see that yourselves, and what is the significance of that to us here in New York, of the inflation seeming to be a little more persistent here in our region?
I really do not know too much about the New York State inflation rate, except I know that inflation rate varies over people. Poor people face higher inflation rate than richer people. It's fairly well known. It hurts them more. But the inflation rate is reasonable now, right? I mean, it's 3-4%. So that is not the issue. Issue is prices are high. It will take a long time for it to come.
I've been seeing for at least our region is over 4.5%. 4.5,
Yeah.
4.8.
That's a high number. That's a high number. I've got the numbers, these are annual numbers. Starting really with 2024, for the nation, 2.9, and then 2.6, and then 2.9, and then for New York State, in other words, you're right. And then for New York State, I've got 24, 3.9, 3.2, and then 3.1. That's forecast for 26. So you're right. You're right in saying that if we're using the consumer price index, which we probably shouldn't, but if we're using the consumer price index, you're right. The numbers for New York State are higher, are somewhat higher. And as to the reason why they're higher, I don't know. Maybe somebody else has an idea.
And should that give us any greater cause for concern over our budgeting?
Yeah. Well, no, not any greater cause for concern. You have to obviously be restrained on spending. I mean, that's the simple answer to it. But I don't think that's the correct answer. I think there's a deeper answer, and I don't know what the answer is. I haven't spent enough time on it. It's a great question. It's an observation and a question, and I just don't know the answer.
Well, I thank you for that and for your assistance in this process, and it certainly gives me cause for concern. And with you, Hugh, for the years that I've been here, you're saying this is the risks are far higher than you've perhaps ever experienced, and the uncertainty expressed by everybody else, I think, should lead us to being more cautious on our spending in the budget than more aggressive with our spending in the state budget. But Dr. Lahiri, if I could just ask you one specific aspect about all the graphs that you showed. One jumped out at me is that electricity production in New York State is on a decreasing chart. Now, we have major electrification goals in this state and processes underway that are ramping up the demand for electricity. Mm-hmm. Yet our state production of electricity is declining over, I think on your graph, about the past 5 or 6 years. That in conjunction with the increasing demands, if we continue to pursue these issues, and with the factors of, I've got in my region now utility bills and constituents going through the roof with 200, 300, 400% increases in their household utility bills, businesses seeing some of the same. But larger than that, moving forward in legislation that's been passed now to implement a climate super fund to put expenses on fossil fuel businesses, and a cap and invest program that's in the regulatory program right now that will put costs on anybody that uses fossil fuels and is an emitter in this state is only going to drive costs up. So what are the more macro concerns with that on New York State and the implications of those impacts on business and potential for growth or higher costs in New York of doing business?
If I may say, the number I gave out, the budget, that's what I came here for, to give out the budget revenue forecast. Those were generated on a real term basis. That is inflation adjusted number, okay? I is not forecasting inflation. I was taking the inflation numbers as such, and then I'm in terms of real revenue growth. Okay, now in terms of electricity, partly has been going down because natural gas has taken over. The use of natural gas industries have increased tremendously. That's the substitution has been going on historically. But I agree that state of New York being close to Quebec and so on, Canada, we are in a particular position to harness a lot of their other sources of energy, right? Or, water and stuff like that can be easily, and we do, right? So it is concerning that electricity or gas prices are going on. But there are other ways of doing that because of our closeness to Canada, I believe, if we can harness that greed more.
Any other thoughts from the others? And we have the Champlain Hudson hydro transmission line coming down, which is going to put more burdens on, again,
so this
homeowners,
whole
ratepayers.
talk of excise thing, it worries me because we in the state of New York need that import from Canada, I think, quite a bit, clean energy.
So, as Senator O'Mara was saying with regard to inflation locally, but we had a CPI downward trend. The last 4 months, inflation has creeped back up a little bit from 2.4% in September to 3% even in January. We had been talking about, in the past, how many rate reductions we might see. So if inflation continues to trend upwards, how long do you see or anticipate the Fed's maintaining the current rates, or is there a possibility that we're going to be looking at rate hikes? It seemed like Dr. Sinclair in particular, I think, may have shown that might be your expectation, that there could be hikes.
Actually, so what the Fed is currently projecting right now is based on their December projections, where the data has evolved since then. They were saying about 2 more cuts this year, 2 more cuts next year. And so the base case is still the next step is cutting rather than raising. I am more in the view of Hugh that I think it's more likely to have fewer cuts rather than more cuts, although the economic data are shifting around, and there's definitely the potential for growth to be more affected. We've talked about the connection between tariffs and prices, but it could also drag on growth, and that connection could result in things going either way, which is why I'm still sticking with that baseline of the next direction being cuts because of the concerns of growth drag. But I think it's much more likely that the Fed will hold where they are for a longer period of time than that they will actually raise. I think it would take quite a bit of additional inflation signal for them to reverse course from their cutting stance and go back to a hiking cycle. But I know that they are watching the data carefully, and I think rather than being concerned about very elevated inflation coming again, I think the Fed will be on it and will tap it down well before we see a big inflation surge if that were to come.
That's a great answer, and I have no reason to disagree at all with Tara. I will simply say I don't think anybody knows, period. We just don't know, and it's very data dependent, and it'll depend on the day. And the best you can do is you can maybe take a guess, but believe me, as the data comes in, the Fed will change. But I think if you're going to make an estimate now, Tara's estimate is as good as any I've heard, and I'm at 1 this year and 1 in 2026, but who knows where I'm going to be in a week. It depends on the data, and I wish we had a good answer for you, but we probably don't.
Thank you. I would just, lastly, I guess ask this as somewhat of a general question, but, we have a proposal that, and I think, there's somewhat of agreement that our tax receipts have been strong and are projecting strong, but, we have a proposal that increases spending another $8.5 billion here, with the potential, or I'd say likelihood, that we're going to go above that number as we get into the final budget. With all of these risks we're talking about, again, it's a general question, but is that an economically wise thing for us to be doing?
You've probably heard us at previous sessions that we've had talk about rainy day funds. I'll leave it at that.
Thank you.
No additional questions for me.
Sadly.
Mr. Johnson, 6,664 S&P year-end 2026?
Yeah, that sounds like about the number I've got. Yeah, that's a 12.2% increase from current
All right.
levels. Yes.
That would be great.
Yeah. Oh,
Can you make sure that happens, please?
if you, yeah, I promise.
Wow.
No, it just gives you a little bit of an idea of what I'm simply doing is quantifying what I think will be the outcome of really the consensus, my own and the consensus forecast for the economy, earnings, Federal Reserve policy, and interest rates. That's statistically sound, but still a guess.
Thank you.
Does anybody else on the panel have any other questions or concerns to share? Well, great. So this concludes today's discussion. I want to just say thank you very much to our panelists for your insight. Offer my apologies for the technical difficulties, but it's nice to, we had a plan B, but it was nice to see you in person as you're talking, to see you virtually and to track it. We do value this discussion. And thank you very much to my co-panelists here, to the elected leaders, to Maria Duelis from the Controller's Office. We appreciate your partnership throughout the year, and we'll work with your teams in the next couple of days to fulfill the requirements under law for the economic and revenue consensus process as we move towards enacting a timely budget at the end of March. So with that, thank you very much. Thanks to folks for joining us, and have a great day.
Thank you very much.